transparency, and algorithmic decision-making is coming at you fast.
Being a successful investor boils down to emulating the strategies of successful investors. And Berkshire Hathaway CEO Warren Buffett is one of the most successful investors of our time.
I would say that at the end of the year, I would think it extremely likely that
he constantly ranks on Forbes' list of billionaires. Follow along as I divulge Warren Buffett's 6 timeless rules investors must follow in 2025 to achieve success. One of Warren Buffett's most famous sayings is, rule number 1, never lose money. Rule number 2, never forget rule number 1. Buffett uttered this line to stress the significance of protecting your capital. Ideally, this means seeking out undervalued stocks and acquiring them at a discounted rate. The goal is to minimize risks and maximize the profit potential. But wait, didn't Buffett personally lose nearly $25 billion in the 2008 financial crisis, costing his company, Berkshire Hathaway, its prestigious 8AA rating?
you expect to hold them for a very extended period, and you are prepared financially and psychologically.
So how can he tell us never to lose money? That's right. But one thing most people don't understand is that the 2008 financial crisis was so deep and protracted that in fact it earned the label the Great Recession. Worse still, what followed the crisis was an unusually prolonged recovery. This crisis quashed several rules of investing. Even the Oracle of Omaha's investing principles crashed. But if you remember well, few people on or off Wall Street capitalized on that crisis as deftly as Buffett. After openly urging Americans to buy stocks as markets reeled, he swooped, positioning himself to make the most of the market mayhem and taxpayer-financed bailouts. This calculated move cemented his legacy as one of the greatest investors ever. So what's the crux of the matter? Seek a margin of safety when purchasing stocks. In other words, look for qualities of an investment that can help protect you from losing money. For example, imagine a stock's value is $10 per share, but the company's assets are realistically worth $12 per share. So there's a $2 margin of safety. This intrinsic value of the assets acts as a buffer that prevents the stock's price from declining significantly. Above all, don't gamble. Going into an investment with a cavalier attitude that it's okay to lose is a bad idea. The stock market will experience swings, of course, but in good or bad times, aim to safeguard your capital. When faced with adversity, the wise choice is to stop actions that might worsen the situation. After all, what do you do when you find yourself in a hole? You stop digging, don't you? Rule number 2, invest in businesses that you understand. Warren Buffett recommends that you only invest your money in companies that you understand well. He calls this your circle of expertise. This idea has helped him make a lot of money over the years. Warren doesn't just throw his dollars at the wind. Instead, he strives to know a company's ins and outs before investing. Take Apple, for instance. He saw beyond their sleek iPhones and dug into their long-term potential. The result? His investment in Apple became worth a lot more as its stock price increased. Understanding what you invest in is one of the most essential things in successful investing. Why? Because when you understand a business, you can make smart choices.
We haven't been allowed to deploy it. Charlie and I talked about this, of course, constantly.
When you invest in a business you're familiar with, you can make wise decisions. You'll have all the information about the company's financial situation, competitive advantage, and how it could look in the future. This means you're less likely to make bad choices. Lower risks. If you put your money in businesses or industries you don't know, you might lose money. If you don't understand how a company works, how it makes money, or how its industry operates, you won't see signs of trouble that could lead to losing money. Be patient. If you know what you're investing in, you'll likely be patient. For example, when the market fluctuates, but you know a company's value, you won't freak out and sell when you shouldn't. Focus long-term. Warren Buffett believes in holding investments for a long time. If you understand the basics of your investments, you'll likely keep them and let them grow over time. Spread out safely. Sticking to what you know allows you to invest in different businesses within your circle of expertise. This way, if one doesn't do well, the others might. Avoid fads and hype. The investing world is full of fads and trends that capture the public's attention. Staying within your circle of competence helps you filter out the noise and avoid investing in things based on market hype. Keep learning. When you invest in what you understand, you learn more about those businesses or industries. This helps you get even better at making investment choices as time passes. Rule number 3, invest for the long term. Buffett once said, if you aren't thinking about owning a stock for 10 years, don't even think about owning it for 10 minutes. Buffett embraces a buy and hold mentality. Instead of buying and selling stocks to make quick profits, He focuses on quality businesses with solid growth potential and holds on to them for the long term. This approach can minimize risks and maximize potential returns over the long run. Buffett himself has held stocks in multiple companies for over 10 years. He's owned stocks in American Express since the 1960s, Coca-Cola since the 1980s, Wells Fargo since the 1990s, Visa since 2008, and Bank of America since 2011, among other notable companies. Buffett's long-term investing strategy underscores the importance of having a patient and strategic approach to your investments. In a world driven by instant gratification and quick results, it's easy to get caught up in the frenzy of short-term market fluctuations and trends. However, adopting a long-term perspective can offer a multitude of advantages. For one, focusing on the long allows ample time for the power of compounding to work its magic. By allowing your investments to grow over an extended period, you earn returns on your initial investment and accumulated gains. This compounding effect can significantly magnify your wealth over time. Second, it reduces stress and decision-making fatigue. Short-term trading requires constant monitoring, quick decision-making, and reacting to market news. This can lead to anxiety, emotional decision-making, and burnout. On the other hand, long-term investing lets you take a step back, make strategic decisions, and avoid being overly influenced by short-term markets. Best of all, it allows you to benefit from economic growth. Over the long term, economies grow, leading to increased corporate earnings and stock market gains. Investing for the long haul allows you to capture these broader economic trends for your greater good. Rule number 4. Be fearful when others are greedy, and greedy when others are fearful. Here comes the juicy stuff, being a bit of a rebel in the investing world. Remember that time your friend ate a whole pizza alone? Well, Buffett's advice is kind of like sharing it when everyone's hungry and ordering your own when they're stuffed. Translation? It might be time to tighten the purse strings when the market's on a spending spree. But when everyone's running for the hills, Buffett's the guy buying up stocks like they're on clearance. Counterintuitive? Absolutely. Brilliant? You bet. This style of investing is directly related to the price of an asset. When others are greedy, the market is often euphoric, and investors are overly optimistic, driving asset prices to potentially unsustainable levels. During these times, Buffett suggests being cautious and fearful, as there might be a risk of an impending market correction. By avoiding the temptation to buy into the frenzy, investors can protect themselves from potential losses when the bubble eventually bursts. Conversely, when others are fearful, it indicates a period of market panic or downturn, often driven by negative news or events. In such times, asset prices can become undervalued due to excessive pessimism. Buffett advises being greedy during these moments. This is when long-term investors can find attractive opportunities for growth because the market's negativity might not accurately reflect the fundamental strength of certain businesses. Buffett has successfully applied this rule multiple times in his investing journey. Take Salomon Brothers, 1991, for example. When the bond trading firm Salomon Brothers faced a scandal that caused its stock to plummet, Buffett saw an opportunity. Despite the negative sentiment surrounding the company, he invested and eventually helped turn it around, generating substantial returns. The 2008-09 financial crisis is another example. During the global financial crisis, markets were in turmoil, and many investors feared a prolonged downturn. Buffett took advantage of the situation by investing in well-established financial institutions like Bank of America and Goldman Sachs. These investments turned out to be highly profitable as markets recovered. Rule number 5. Buy a wonderful business at a fair price, not a fair business at a wonderful price. Warren Buffett's strategy is to buy wonderful companies at a fair price and not the other way around. The reason is simple. The fair business is what Buffett calls cigar butts. Investing in a fair business is tempting because of its lower initial cost. But in reality, such a business inherently carries more risks. A fair business might lack the essential qualities needed for long-term success, such as a competitive advantage, strong management, and a durable business model. Such a business will produce a tidy one-time profit. For the most part, you'll profit only from the price discrepancy, and once it's corrected, you're doomed. Even if you get such a business at a wonderful price, its underlying limitations could hinder its growth and sustainability over time. On the other hand, the wonderful business has the potential to generate substantial returns over the long run. A wonderful business often possesses a strong brand, consistent and growing cash flows, a wide economic moat, and the ability to adapt to changing market conditions. These factors can lead to compounding growth and a higher likelihood of delivering superior results to investors in the long term. So even if you buy such a business at a slightly higher price, it's more likely to maintain its profitability and market dominance over the long term. A great example is when Buffett invested in Coca-Cola in 1988. The company was worth around $1 billion at the time. Today, the dividends alone earn him more than half of that annually. Rule number 6. Seize the golden opportunities. This rule is about jumping on opportunities like your life depends on it. Have you ever missed a bus by a split second? Warren knows that feeling, except with investments. He's always on the lookout for hidden treasures. Remember the Great Recession? While folks were clutching their wallets, Buffett was making moves. That's the kind of foresight that separates the average from the exceptional. Yet the biggest mistake we make is the mistake of omission and not commission. Not acting on promising opportunities is a bigger mistake than making investment decisions that don't pan out as expected. Successful investing requires taking calculated risks and participating in potentially rewarding ventures. Inaction due to fear or uncertainty can lead to missed opportunities for wealth creation. But how do you know when a golden opportunity presents itself? To effectively seize golden opportunities, you must stay informed and vigilant. Be on the lookout for companies with strong fundamentals and competitive advantages that have temporarily fallen out of favor due to broader market sentiments. By meticulously evaluating a company's intrinsic value and potential for recovery, you can make investments that offer favorable risk-reward profiles. Buffett's success is partly attributed to his continuous learning and ability to maintain a clear perspective. If you are concerned about your financial security and are thinking about investing, check out the first link in the description. It's the platform I use, Interactive Brokers. Click the link to learn more, even during market turbulence. If you have made it this far, I can't thank you enough. Before you head off to implement these principles, please tap that like button, share this video with your fellow aspiring investors, and if you're subscribed to our channel so you don't miss a thing. See you in the next video.